Okay, good morning. Welcome to the FCCJ. I'm your moderator, Andy Sharp from Bloomberg. Apologies for the late start. Dr. Roubini was apparently held up somewhere. So anyway, we're going to talk today about the global and the Japanese economy. And I mean, on the global side, we're seeing spluttering economy in China, commodity price slide, especially oil, Fed's rate hike, etc. Financial markets are getting a lot of jitters these days. And also, there's a multitude of risks in Europe. So our guest today, Dr. Nouriel Roubini, is here today to give his thoughts on the global economy and the situation in Japan. And his words carry weight as he was one of the few economists credited with predicting the 2007-2008 crash of the housing bubble, earning him the nickname of Dr. Doom. But this time round, he does not seem to be such a merchant of doom. In the Nikkei this month, he wrote a piece in which he played down the prospects of another meltdown. However, he said the recent turmoil is likely to be more serious than any other period of volatility since 2009. So we can talk about the global economy there. And on Japan, it seems like deja vu all over again. Abe is about to call another snap election tied to yet another postponement of the sales tax. And earlier this month, Dr. Roubini downgraded his growth and inflation outlooks for Japan, saying that Abenomics is still not gaining traction. He also raised concerns about the Bank of Japan's adoption of negative rates. So just a quick background, Dr. Roubini is the co-founder and chairman of Roubini Global Economics, a professor of economics at New York University's Stern School of Business. And just to abbreviate his very lengthy CV, he has extensive policy experience at places such as the White House and the Treasury Department. So Dr. Roubini will give a short speech of maybe 20-25 minutes, followed by Q&A. So, Dr. Roubini, if you could.
Okay.
Sorry.
Okay, good morning, everyone. It's a great pleasure now being here today. I'll speak for a while and give you the way I see myself and my team at my economic consultancy, Roubini Global Economics, the global economy, and leave some time for Q&A. And the first observation might be that, of course, this year has started with a period of significant turmoil in financial markets, risk-off episodes, risk aversion rising. But in the last few weeks, there has been a bit of a reversal of the market correction that has occurred. The markets were highly volatile through the middle of last month, and then we've seen suddenly a recovery of risk sentiment. And I think one of the open questions is, will this recovery risk sentiment will continue? Will some of the global tail risks that emerged in the beginning of the year materialize again? And therefore, what is the outlook for the global economy and also for financial markets? Now, while I'll spend most of my time talking about what were the sources of risk that emerged in the global economy in the short term, I would like to start making some observations slightly more about the medium and long term, because they frame also then the outlook over the short term. And the key observation here to make is the following one. Over the medium long term, the potential growth rate in the global economy has fallen, both in advanced economies and in emerging markets. So we live in a world that we at Roubini call the new abnormal. Some people in China call it the new normal. The IMF calls it the new mediocre. Larry Summers refers to it as being the secular stagnation, and other people like Ray Dalio at Bridgewater calls the great deleveraging. But regardless of the semantics of whether you want to use one term or another, and we're more comfortable with the idea of a new abnormal, one of the features of this new global economy is potential growth is lower than otherwise. And that's an important implication for economies and also financial markets. Why potential growth is lower than it was before, not just in advanced economies and now also in emerging markets? I think briefly there are 7 factors that are worth mentioning. The first is that we are living in a world in which there is too much debt, private and public. And eventually, this high debt and the need for deleveraging implies crowding out of investment, and with less investment, you have less economic growth. Second factor, demographics. There is aging of population both in Europe, Japan, but also in the United States, but increasingly even in some important emerging markets like China, like Russia, like Korea, where I was just yesterday. And everything else equal, potential or trend growth depends on population growth. Less people means less potential growth and also less need for investment. Three, after the global financial crisis, there was a collapse in private investment throughout the world. And there are many reasons behind that one, but the recovery of private investment has not occurred. Investment rates as a share of GDP are still low. They may be rising gradually, but they're very low. And the lack of investment implies that potential growth is lower. So the two key elements of potential growth, the labor input and the capital input, are growing less fast than the past, and therefore potential growth is lower than the past. Now, there's a question mark on why corporations that are flush with cash and profits are not doing as much capital spending. Maybe lots of stuff, including demographics, including policy uncertainties, including lack of aggregate demand. We can discuss it, but the reality is that there is slower investment and therefore slower potential growth. Four, in a world in which the capital and labor input is growing more slowly, and therefore potential growth is lower, one way of increasing potential growth is to do the kind of structural reforms that increase total factor productivity growth. But the reality is that the political economy of structural reforms, whether it's in an advanced economy or an emerging market, whether it's in a democracy or a less democratic country like China, implies that in the short run there are costs, and including political costs, and the benefits occur only over the medium long term. And therefore, the attitude of most politicians is to kick the can down the road and postpone the kind of structural reforms that are necessary. And therefore, those reforms are occurring much more slowly than is optimal, desirable, and therefore the lift to potential growth is not occurring. Fifth factor is what economists call hysteresis. The cycle can affect the trend. If resources remain unemployed for a long time, like labor, you lose skills, you lose your human capital. There's a stigma of being unemployed for a long period of time. There's less investment in capital, and therefore a cyclical depression like the one in the Eurozone that lasts for almost a decade eventually can affect the trend growth of the economy. Sixth factor, the rise in income and wealth inequality. Leaving aside the question of whether it's fair or not, the economic consequences of it are that you are redistributing income from labor to capital, from wages to profits, and from those who have a higher marginal propensity to spend, low and middle class households, to those who have a higher marginal propensity to save, higher income and higher net worth individuals and households and corporations. And therefore, that redistribution of income slows down consumption growth and slows down the potential growth of the economy. Finally, as we know, around the world there are policy uncertainties, political uncertainties, and geopolitical uncertainties. And those uncertainties, of course, may have an impact on investment and therefore affect potential growth. So, unfortunately, potential growth in the global economy is lower. That's the new abnormal or the new mediocre. Second observation is important here. Actual growth in many countries for the last few years has been below potential. So potential growth is falling, but actual growth is below potential. And it's below potential not just in advanced economies, but now even in many emerging markets that have a slowdown in potential growth, the actual growth is now below potential for a series of reasons. The first and most important reason is that when you have too much private and public debt, there is a period of time, can last up to a decade, where you have to spend less in the private and public sector to save more or save less in order to stabilize debts and eventually reduce them. That's what's called deleveraging. And for that deleveraging to occur, for any level of your potential growth, your actual growth has to be below potential. And that's what's happening initially in the United States, then in Europe, and the third leg of this great deleveraging is now occurring in emerging markets that had a significant increase in the private and public debts in the last decade. Second point here is that the policy mix has been suboptimal. Throughout the world, there has been too much reliance on monetary policy and unconventional monetary policy, terms that did not even exist a decade ago now have become the norm. 10 years ago, we had heard the term ZIRP, zero interest rate policy, the term QE, quantitative easing, the term CE, credit easing, the term FG, forward guidance, the term unsterilized effects intervention, and now the newest in the policy tool of central banks, NIRP, negative interest rate policy, and increasingly so. So monetary policy has become increasingly unconventional, and while monetary policy can have a positive impact on aggregate demand, the policy mix has been suboptimal. Too much reliance on monetary policy and not enough reliance on fiscal policy, even in the countries where there is a fiscal space. And there are a whole bunch of economies in the world where the fiscal space is there for using more fiscal policy as a way of monetary policy to boost aggregate demand. And therefore, this suboptimal policy mix has implied that growth has been disappointing on the downside and in a significant way. So this is the kind of a background to think about what's going on in the world. Now, if I'm asking myself why there has been this recent episode of risk-off in financial market, and now why risk is on, and whether for the rest of the year we're going to see more risk-on or risk-off, and what's happening to the global economy, the most recent risk-off episode that started at the beginning of the year can be driven by at least 8 separate factors that at different point in time between January and February had different importance. First risk factor, of course, was the concerns at the beginning of the year, again, like in the summer of last year, that China might have a hard landing. Economic data out of China started to surprise again on the downside. People say the economy is again in free fall, the currency is going to collapse, the stock market is going to collapse. So the entire saga of market concerns about China and a hard landing of China occurred in August and September of last year, repeated again. Now, my view and the one of my firm has been all along for the last few years that the two extreme views about China, the optimistic there'll be a soft landing of 7% plus growth for as far as the eye can see, or the other extreme of a hard landing with a real recession and collapse of the economy, both views are extreme and they're incorrect. We've been saying for the last few years that China is not going to have either a soft landing or a hard landing. It's going to have a bumpy landing or a rough landing. If I had to give you a point estimate, I would say the true Chinese growth this year, in our view, is closer to 6% rather than the official 7%. And by the next few years, the potential growth of China is barely 5%, and therefore the economy has to slow down towards, at best, a 5% growth. Now, the good news about it is not a hard landing. The bad news is the Chinese economy is slowing down from 7 to 6 to 5. Of course, it's going to be a source of significant economic and market volatility, including the impact on commodity prices and all the rest. And I can elaborate on why I think China is going to have a bumpy landing rather than a hard landing. But the markets have gone from too optimistic about China to too pessimistic, from saying the Chinese are the most brilliant technocrats in the world and cannot go any wrong, to now say they're incompetent, they cannot stabilize the economy, they're making policy mistakes, they cannot stabilize the stock market, the currency, and things are terrible. I think the both extreme views are incorrect. Markets tend to be manic depressive, going from too much optimism to too much pessimism. The reality of China is different, and I'm leaving tonight for Beijing, where I'm going to spend 4 days trying to get a better assessment of the Chinese economy. Second source of the market concern was the United States and the Fed. Suddenly, at the beginning of the year, the U.S. economic data started to surprise on the downside, and people started to talk even about the risk of a U.S. recession and that impact on the global economy. And related to that one, there was also the concern that the Fed had made a policy mistake in December by starting to hike rates when there was no inflation, and that the Fed was being committed to signaling 4 hikes this year that were something that was excessive given what was going on in the global economy and the U.S. economy. And of course, after the December decision of the Fed, 3 things happened that suggest that this was a mistake. 1, growth in the fourth quarter started to surprise on the downside. 2, because of the fall in oil prices, inflation was expected to go south rather than north. And 3, the global financial turmoil, with its impact on the stock market, on credit spreads, and the dollar, was a significant tightening of financial conditions that would weaken further inflation and growth in the United States. So market concerns about U.S. growth and about the Fed. Third market concern, oil prices. There was a sharp fall in oil prices to well below $30 per barrel through the middle of February. You would think that a fall in oil prices will be a positive for the global economy and the market. Why? You're redistributing income from those who have a higher marginal propensity to save, that are all exporting countries, to those economies who have a higher marginal propensity to spend, that are all importing countries. And if you think about it, some of the key major economies and regions of the world are net all importing. Even the US, with production of oil, is still a net importer of oil. Europe, Japan, China, India, Korea, Turkey, and so on. Of course, there are winners and losers. Winners are the all-importing countries. The losers are the all-exporting countries. The losers are producers of oil, even in countries where there is a net import like the United States. And the gainers are, of course, the consumer of oil. But the net impact for the global economy over time should be positive. So why every time oil prices were falling, US and global equities went south, credit spreads went to the roof, and inflation expectation collapsed? I think three reasons. First reason was that there was a concern that the fall in oil prices represented not another positive supply shock, say the return to the market of Iran after the liftoff of the sanction, but was rather a signal of weak global aggregate demand and growth. After all, Chinese growth is weak, emerging market growth was weak, and even concern about the United States. First reason. Second reason, in the US, in the short run, the impact of lower oil prices is more significant on production, employment, and capital spending in the oil and energy sector. And this oil and energy sector is a significant part of the S&P 500 stock market, while the beneficial impact on consumption occurs only gradually over time, because consumers tend to save the oil windfall before they spend it. So you had initial impact negative on production and the stock market. And three, the impact on credit spreads is, of course, with a sharply lower oil price, there'll be widespread bankruptcy between oil and energy firms in the United States, but also financial distress in oil, energy, and also commodity-producing countries among emerging markets. And therefore, the risk of default by sovereigns, by state-owned enterprises, and private sector firms that are in the oil, energy, and commodities space. Therefore, paradoxically, the fall in oil price was leading to a collapse in US and global equities, a very sharp increase in credit spreads in US and globally, and a sharp fall in inflation expectation. Fourth concern about the global economy, concerns about what's going on to European and global banks. If you think about it, the business model of many global banks is now challenged by greater supervision regulation, more capital, more liquidity, and less leverage. First point. Secondly, the fintech revolution implies that over time, payment system will be disrupted. Asset management, insurance, even lending is going to be disrupted by new technology. And many banks don't have a sound business model. Three, the impact of more central banks going in the direction of negative policy rates had potential impact of reducing the net interest margin, the profitability of the banking system. Four, there is still significant amount of non-performing loans, rising ones in the exposure of banks to oil and energy in the United States, to oil, energy, and to commodities in emerging market, and the exposure of European banks to lots of bad assets in Italy, in Spain, in Portugal, but possibly even in places like Germany, and the exposure of European and other banks to emerging market as well. Final concern about the banking system, the new bail-in rules in Europe imply restriction to state aid if there is a bailout of banks, and therefore another situation in which the losses are going to be taken by the creditor of the banking system as opposed by the taxpayer. So the combination of all these factors led to concern about the banking system globally. Fifth factor that was behind the concerns in the market, Europe and the Eurozone. Now, Europe and the Eurozone is in a cyclical recovery. And guess what? Quantitative easing, negative policy rates, bond yields close to zero, spreads of the periphery lower euro, higher stock market, at least for a while, and oil at $30 per barrel as opposed to $100 per barrel. If that's not going to lead to a cyclical recovery of the Eurozone, what else will lead to a cyclical recovery of the Eurozone? That's the good news of the Eurozone, but that's the end of the good news. What are the bad news about the Eurozone? Refugee migration crisis and the risk of a collapse of the Schengen Treaty. The weakening position of Angela Merkel because of the situation in the migration and the way the migration crisis has been mishandled and the losses that now her party has suffered in the regional election, and therefore the risk that she might lose power. 3, the risk of Brexit, that the Brits are going to decide to exit the European Union. That might be the beginning of the end of the European Union. If the UK exit the European Union, the Scots might exit the United Kingdom, the Catalans are going to say we want to leave Spain, the Nordic member of the European Union might decide to leave the European Union. It could have the beginning of the unraveling of the entire European Union. Additionally, the risk of Grexit, that Grexit has been only postponed as opposed to be avoided, and there is a state of the world where that will occur. Additionally, the concerns about the European banks, and I fleshed them out. On top of it, there is a rise of the influence, if not the power, of radical populist parties of the right and the left in Europe. You see it in Greece, you see it in Spain, you see it in Italy, you see it in Portugal, but see what's happening in places like Hungary, Poland, Slovakia, Czech Republic, where neo-fascist, if not neo-Nazi parties are becoming politically more popular, or what's happening even in Germany or Finland, in Sweden. Throughout Europe, of course, economic malaise implies that very populist, radical party of the right and the left that are anti-free trade, anti-migration, anti-Muslim, anti-market, anti-globalization, anti-even the existence of the euro are becoming more popular, and that could be source of stress. And finally, unfortunately, Europe lives in a bad neighborhood. At its border are the major wars and the failed states of the Middle East. You have the Russia-Ukraine situation. You have Russia becoming more aggressive in the Balkans, becoming more aggressive in the Baltics, and of course the risk of terrorism. The issue in Europe is not whether more terrorist attacks are going to occur. The only question mark is when they're going to occur again and where they're going to occur again. So concerns about Europe became important. 6 concern in the market, emerging markets. If China were to have a hard landing, if US has a sharp slowdown, or the Fed makes a policy exits too fast, if oil, energy, and commodity prices collapse, that's bad news for emerging market. Of course, there are 3 major global headwinds that have been hitting emerging market since 2013. One is the slowdown of China. The second one is the end of the commodity super cycle. The third one is that, however slowly, the Fed is going to exit the zero policy rates. So you have these global headwinds that are hitting emerging markets. A number of emerging markets are also macroeconomically in the wrong position. They had loose monetary, fiscal, and credit policy. They're fragile. They have rising twin current account and fiscal deficits, falling growth, rising inflation. Now they have to tighten their macroeconomic belt. That's a problem in many parts of emerging markets, not all of them. And finally, like in advanced economies, with the exception of maybe India, Mexico, structural reform to increase potential growth, when potential growth has been falling for a number of factors, are not occurring in most of these emerging markets. And of course, if the world economy were to get worse, if China, Europe, US, if oil prices were to fall, that will be the trigger for significant further economic distress and financial distress for many of these emerging markets. 2 final observations that are important. One is concern about geopolitical risks. The Middle East is burning. You have a proxy war between Sunni Saudi Arabia and Shia Iran that may be a 30-year war. Proxy wars have led to failed states from Iraq to Syria to Yemen to Libya and so on. The Middle East is burning, and eventually you see what happens in terms of spillovers of terrorism and migration to Europe. There's Russia and Ukraine. In Asia, of course, there's debate about whether the rise of China is going to be peaceful or not. A long-term issue. There are lots of other things that can go wrong. Final source of market concern. We live in a paradoxical world in which on one side there is huge amount of macroeconomic liquidity, QE1, QE2, QE3, negative policy rates. From a macro point of view, the central banks have flooded the market with liquidity, but we're also in a world in which there is market illiquidity. Because of regulation and supervision, the market makers, traditional investment banks, broker-dealer were market making for equities, for credit, for fixed income, are doing less so. They're holding less inventory, while there's been a huge issuance of fixed income instruments for the last decade, and therefore any economic shock has greater volatility on a variety of financial markets because the buffer of the market makers is not there anymore. And that has been one of the sources of the market volatility you have seen in a number of these episodes. So any fundamental shock related to more asset price volatility because of the market illiquidity. Now, Japan was not at the center of the global concern, but I would say one thing. The way the first announcement in January of the move to negative policy rate occurred in Japan had ripple effects, because suddenly negative policy rates that had been introduced initially in Switzerland, in Denmark, in Sweden, and then in the Eurozone started to have a bad name. That was the moment in which suddenly people, when the Bank of Japan went to negative and surprised the market, people said, you are killing the banks, you're killing their net interest margins, that's going to lead to a reduction of credit growth, it's going to lead to lending rates going higher, and therefore this policy tool not only is ineffective, but potentially could be counterproductive, and therefore negative policy rates started to have a bad name. I'm not actually of the view that we should rule out the use of negative policy rates. You can work on the quantity of money, quantitative easing, you can work on the price of money. And if real rates are too high and you have to reduce them to boost the economy, unless you can increase inflation, this is increasingly hard, then you might have to go negative for the policy rate. So there is an economic argument about going negative with the policy rates at the same time as you're doing also quantitative easing, but you have to do it in a way that is messaged right, communicated right, to have the right economic consequences, the financial consequences. So I'm not against it, but certainly negative policy rates started to have a bad name given the way the announcement of this in Japan was somehow botched. Therefore, Japan indirectly became part of course, of the problem rather than part of the solution. Now, since the middle of February, there has been a reversal of these concerns about the markets. And actually, as of yesterday, the US stock market has retraced fully the 10% plus correction that occurred in the first month and a half of the year. The question you have to ask yourself is, of course, why that retracement has occurred and whether it's going to be persistent. The reason why risk is now on rather than off are briefly several. One, China is not in a hard landing. The data are mixed and not great, but it's not collapsing. And China signaled that if this economy is not collapsing, the stock market is not going to collapse, and they're not going to have a sharp devaluation of the currency. Two, US economic data are starting to surprise on the upside, and therefore US is not going in a recession. Three, oil prices were too low, and as oil prices have gone higher from below 30 to 40, US and global equities are higher, credit spreads are lower, inflation expectations are rising. Four, if China is not going to collapse, if US is not going to have a recession, if the Fed is going to go more slowly and oil prices are higher, emerging markets are not going to have a systemic meltdown, the one people were concerned. And finally, of course, the policy response has stabilized against the market. The PBOC has done more, the BOJ has done more, the ECB has done more, the Fed had said we stay on hold later and slower, and we're going to hike not 4 times this year, but at most 2 times. And of course, with the Brexit referendum and inflation very low, the Bank of England is not going to raise rates anytime soon. So again, the policy response uncoordinated of the major central bank has now backstopped the market and backstopped the economy. I will make, however, the final observation here. Is this the last episode of risk off? And is this recovery of the market continuing? I don't think it is going to be the last episode this year. We'll have more of them for several reasons. Reason number one, in the past, whenever there was a risk-off episode, there was one cause of it. Now I gave you 8 reasons for it. In the past was maybe in 11, concerns about the Eurozone collapsing. In spring of last year, Brexit. In the summer of last year, China. I gave you 8 sources of global financial risk. Secondly, in the past, there were growth fears that turned out to be wrong, while today I think there is a growth slowdown. If you look at the global forward-looking indicator, the mild expansion in the global economy that started in October of last year is becoming already a slowdown. Not a contraction, but a sharp slowdown in advanced economies and emerging markets. Final factor that is important here. In the past, the policy reaction was perceived to be strong and effective. Today, there is a perception that eventually central banks that are the only game in town are running out of bullets, or that are becoming more esoteric in new instruments, and these new instruments may become less effective. after Q1, Q2, Q3, suppose the Fed was going to Q4, how much of an effect will have. And otherwise, there is even the concern that some of these instruments, like negative policy rates over time, might actually have a counterproductive effect by damaging the financial system. So suppose another risk-off episode were to occur, and you have the financial condition tightening, the economy weakening, and economic weakening leading to weaker financial conditions. You have a negative feedback between asset price and real economy. Suppose at that point the policy response occurs, but is ineffective or counterproductive. Then the free fall of asset prices and the free fall of the real economy may not occur. And since there are at least 8 potential sources of global tail risk, some of which might occur again, China, US, Europe, oil, commodity, emerging markets, geopolitics, and so on, the risk that something goes wrong and then the markets don't react well because the policy response is botched is a risk that is rising significantly. I will stop here and take questions. Thanks.
Okay, thank you very much for your very thought-provoking speech. Okay, we're going to extend the press conference by 5 minutes or so because of the late start. So Q&A from the working press first. We'll start with Anthony. Please give your name and affiliation. And can I remind you all to keep your mobile phones turned off? Thank you.
Anthony Rowley, Singapore Business Times. The moderator said you were not in aggressive Dr. Doom mood today. I would hate to hear you when you are. But my question is, you say there's a deficit of demand in the global economy, which is obviously true. And there does seem to be a swing now towards favouring more fiscal stimulus. Japan is going to emphasise this factor, I think, at the upcoming G7 meeting. But my question is, how much fiscal space is there, either in the advanced economies or the emerging economies, for stimulus? And do you expect to see central banks directly underwriting government debt in the near future in order to finance stimulus?
Well, you know, the fiscal space depends on the countries. Not all countries have significant amount of fiscal space, but I would say the constraints actually to more active use of fiscal policy as opposed to relying to monetary policies, the only game in town, have been more political. You know, in the US, because of the budget agreement, we have had consolidation of the fiscal budget has been too much, too fast, too soon. In the Eurozone, because of the constraints of the Growth and Stability Pact, there was front-loaded fiscal consolidation. For a while, also, Japan was doing front-loaded austerity, and then that was postponed once, and they may postpone again in April of next year, the second hike in the consumption tax, and so on and so on. So I think some of them are political constraints rather than economics. Which are the countries that have a fiscal space? I would say the US has fiscal space. You know, the budget deficit has gone from 10% of GDP to only 3% on a temporary basis. If you needed less fiscal drag, more fiscal stimulus, more infrastructure spending, you could do it. China has some fiscal space of the right type of fiscal policy. Instead of doing another round of credit fuel fixed investment, where you have too much fixed investment and you have lots of bad assets, bad liabilities, you have to create a social safety net of a traditional Keynesian type to boost private consumption, rebalance the economy towards consumption and consumption of services. I was just in Korea. Korea has a fiscal space. I would say Japan also has fiscal space because while in the medium term fiscal consolidation should occur, if the growth falters and you have another recession, that dynamic becomes unsustainable eventually. While if you can boost economic growth, then you can reduce debt and deficit through economic growth. Of course, you need to do fiscal consolidation, but the timing of when you do it as opposed to doing more stimulus is an important one. Canada has fiscal space. Some of the countries in the periphery of the Eurozone have done a significant amount of fiscal consolidation. So the issue is, do you want to have further draconian fiscal drag the way the Growth and Stability Pact requires, or you want to phase in the fiscal austerity more slowly and so on? And within emerging markets, of course, some emerging markets like Brazil don't have any fiscal space. If anything, they have to do significant fiscal consolidation. But there is a wide range of emerging market economies with low inflation, low budget deficits, low stocks of public debt, where the fiscal tool, if necessary and desirable, could be used. So I think that actually there is room for doing it if there is the political willingness to do it.
Central bank underwriting?
Well, I would say central bank, in some sense, when they've done quantitative easing is effectively a way of financing deficit spending, because you're essentially buying debt that was issued in the recent past to finance budget deficit. So it's a form of debt monetization or monetary financing of fiscal deficit, even if, of course, all central banks will deny doing that. And in the Eurozone, of course, there are even legal constraints to the ability to do debt monetization. I think the next step of debate is going to be about whether you do just quantitative easing or you do what is referred to as a helicopter drop of money. And the difference between quantitative easing and helicopter drop of money is not the difference between doing monetary financing of deficit spending or just debt monetization. The difference is that in the case of quantitative easing, the debt monetization, technically speaking, should be only temporary, because eventually the balance sheet of, say, the Fed should go back to what was before. While if you accept the concept of helicopter money, you're saying the debt that the central bank buys is going to exit out of the system because it's going to be replaced by a zero interest rate liability of the central bank that is base money, and therefore is a permanent monetization. So the difference between QE and helicopter drop of money is not deficit financing through money. In both cases you do it. In one case it's temporary, in the other one is permanent. And I think the argument for permanent debt monetization is now becoming increasingly something that many people are discussing and supporting.
Okay, thank you. We'll come here and then we'll go to Toru.
Siegfried Nittel, writing for the Austrian newspaper, The Standard. You said in the beginning, structural reform needs a long time and it's expensive, and that's the reason government are shy in make a structural reform. But when you said, then you said as a solution, there is a lot of fiscal space to act for the government. But would not be structural reform the best way to solve the crisis of the world economy, perhaps in Japan, in Europe, and in China? It's not the easiest way, but I think it's would it not be the most sustainable way to solve the crisis?
I think everybody in the world is in favor of structural reform that increase the potential growth of various economies. And Japan, third arrow of Abenomics, is structural reform. Even in Europe, there is emphasis on structural reform. Even the US needs plenty of structural reforms that are not occurring, from entitlement to immigration to regulation to corporate taxation and so on. Even the US is not doing, let alone many emerging markets. But I would make the following observation. First of all, even if potential growth is lower and you want to increase potential growth, in many economies in the world, starting with the Eurozone, the actual level of output is well below potential. There is a huge slack in the labor market with the unemployment rate at 11%. The structural employment rate in Eurozone might be 7, might be 8, might be even 9, but the difference between 9 and 11 is not structural, it's the cyclical. So whenever you have an output gap and you have a slack in the labor market, the structural doesn't help you. You're first to increase aggregate demand to that level of output, and then you can increase the potential. In order to increase the level of aggregate demand to the level of current output, you need to use traditional monetary and or fiscal policy. So there is a room for macroeconomic policy to at least push the economy to that output level, and then the structural reform makes sure that that output level potentially grows faster than before. So the two things are not inconsistent with each other. And in the economies where you're closer to the output gap to be filled, for example, some people would argue that in Japan the unemployment rate is close to 0, then you have to work more on the structural side. Or in the United States, where the output gap has been shrinking with unemployment right now below 5%, then you have to work even on the structural side. But in places like the Eurozone or other parts of the world where there is still a huge output gap, using appropriately monetary and or fiscal policy to boost aggregate demand is important. And as I pointed out at the beginning, this hysteresis hypothesis suggests that if an economy is cyclically depressed for too long, eventually you can even damage the trend growth of the economy because people become less employable and therefore the potential growth of the economy falls. That's why the risk of maintaining a slack in the economy and damaging the long-term prospects of the economy is an important one. So I would say you have to work on the structural and the supply side, absolutely so, but in an economy where the demand is below the supply existing, you have to work also on the demand side. And that's where monetary and fiscal policy have to play a complementary role to the structural stuff.
Okay, Toru, and then we'll go to George, and then you.
Hi, Toru from Bloomberg News. You said you are not against negative rate per se, and BOJ adopted negative rate policy to achieve 2% target. Do you think that was helpful to achieve their goal? And do you think that's going to work? And if so, do you think they need to cut the rate further? And another topic is that you said Japan may postpone sales tax again. Do you think Japan should postpone sales tax or not? Thank you.
Well, you know, on the first issue, I would say that if the economy is surprising on the downside and inflation is too low, and there is a risk of another recession, and by the way, in the case of Japan, the first estimate of Q3 growth was negative, then revised to an epsilon positive. Q4 has been negative, and I would say there is at least a 50-50 chance, if not more, that the Q1 number will be negative, in which case you have 2 consecutive quarters of negative growth, and you have another recession, at least technically. Then it means that there is a risk that aggregate demand is not appropriate while you're working on the supply side, and you have to take action. And then there is a debate on how much you're going to have to use monetary policy as opposed to fiscal policy. I would say my view will be that you have to use both. There is an argument for additional monetary accommodation, and there is an additional argument for additional postponement of the fiscal adjustment. Starting with the second one, some people say, let's wait until the end of this year or early next year and see whether the economy is good or bad. And based on that one, let's decide whether to postpone the hike in the consumption tax that is supposed to come into effect April of next year. I think that will be a bad idea because we already know the economy is weak. We know the outlook has weakened. Even the BOJ that did not take action this month has significantly revised downwards its growth and inflation outlook. And last time around, when the consumption tax went up, the consumer took a beating and then they cut sharply their consumption. This time around, the consumers know that a year from now, as officially stated, there'll be a raise of their taxes. And I think that part of the weakness you're seeing in consumption today in Japan is that people are starting to save in expectation of the reduction in their income after the consumption tax is going to go up about a year from now. And therefore, if you want to stop a perverse effect on consumption, and the latest data suggests that investment actually is doing okay in Japan, the weakness has been in consumption, and the recent negotiations between workers and the firms on wage increases suggest, as of now, that the wage increases this year are not going to be any better than those of last year, and therefore the objective of the government to accelerate wage growth to boost consumption through disposable income is not happening. Then you need to boost the disposable income of the household sector. Otherwise, you're going to have a recession. And I would rather announce soon that this consumption tax increase is going to be postponed until economic conditions are better and justified, rather than wait, create this uncertainty that's going to lead consumers to say, better safe than sorry. If I'm going to lose my income and my job, I'd rather save today, and that becomes self-fulfilling. So I think there is a strong argument for deciding now, soon, rather than waiting on that one. On monetary policy, I would say that a combination of using the price of money and the quantity of money is more effective than just using the price of money or the quantity of money. And in that context, I think that the BOJ has room to increase, if they decide, the pace of purchases to something higher than 80 trillion annual, and they can also widen the range of assets or maturity of things that they buy and so on. That might be one way of increasing the pace. But I think that actually properly managed, and especially if you have a multi-tier system that reduces the damage, and after all, only I think 20 trillion out of 260 trillion of excess reserves are subject to this tax. So it's a small fraction of it. A properly managed negative policy rate can also be supportive of inducing the banks not to keep all this hoarding of these excess reserves, but rather lending it out to the real economy. And of course, as they get rid of those excess reserves, there's also a potential impact on the currency. So the channels of transmission to the real economy of that negative policy rates are several. So I think a combination of those two policies is probably ideal. And there are pros and cons on choosing one or the other, or a combination of the two. And I would expect, that's my own personal guess, that the BOJ would not rule out going in both directions in case additional monetary accommodation becomes necessary and desirable. And given how the economy is doing, I think that additional monetary accommodation sometime in the spring will likely to occur.
Thank you very much. Okay, we'll go to Georges now, and then you.
My name is Baumgartner. I'm working for Swiss television. How much longer the euro can survive if Europe is such a basket case? And what about Japan? How much longer Japan can survive with such a huge level of debt, bad demography, and 30 years of stagnation and the incompetence of its elites?
Well, on the first one, of course, nothing is deterministic. There is a scenario in which both the Eurozone could fall apart, and even the European Union, if Brexit starts to occur, could start to disintegrate. And in my view, that scenario of the Eurozone falling apart is a scenario where if policies to boost economic growth in the short term are not implemented and achieved in the Eurozone, as we have seen, economic depression, double dip, triple dip recession, deflation, there's a huge increase of the support of populist parties of the right and the left. Even in the United States, by the way, where growth is much better than Europe, unemployment is only 4.9 rather than 11, you are seeing the Trump phenomenon and the Bernie Sanders phenomenon of essentially the angry white underclass or blue collar saying enough of this pain economically. And the US is much better shape because at least people have jobs. In Europe, people don't even have jobs. So that type of anger and backlash against migrant, globalization, trade, inequality, markets is much more severe, as we've seen in Europe. So the risk in Europe is that if you don't really start growing faster, you go back to the 1930s, where you saw first Mussolini, then Hitler, and then Franco coming to power. That's the risk, and ugly thing happens. That's why while you're working on the structural, you have to make sure that there is enough economic growth that boosts jobs, because if people don't see the light at the end of the tunnel, eventually these centrist government, center-left are going to be increasingly challenged by much more radical parties that may eventually come to power, and that's a serious danger. That's one element of the risk of a Eurozone disintegration. Secondly, we know that any monetary union to be viable requires also a full economic union, a full banking union, a full fiscal union, and eventually also a full political union, because if you're going to transfer national sovereignty on monetary, exchange rate, fiscal, banking, economic, capital market issues from the nation states to the center, there's a question of democratic legitimacy, and therefore you have to have institutions where the democratic legitimacy is maintained. And therefore, a monetary union alone is not viable. The problem is that, of course, if you move to a full union, there is also risk sharing and there is solidarity at the union level of risk for the banks, for the fiscal, and so on. And the Germans say, we don't want a full union because we worry that a fiscal union becomes a transfer union, that risk sharing becomes risk shifting. And until these countries are going to do enough structural reform, austerity, and converge to our growth rate and growth model, we don't want to have risk sharing that becomes risk shifting. The trouble is that if you don't have risk sharing and solidarity, the foundation for that economic and monetary union fall apart, and eventually you'll have a risk of disintegration. So The question on the European Union or the Eurozone is, can you move, however gradually, in a direction of a greater risk-sharing, greater solidarity as you do the reforms, the austerity, and you jumpstart economic growth. Otherwise, the Eurozone probably over the medium term is doomed, even if in the short run, with the ECB buying all these bonds, bond yields are close to zero, the peripheral spreads are very low, the risk of a real severe economic or financial disruption in the short run is limited. Now, in the case of Japan, I would think that in the short run, again, debt monetization implies that the risk of a fiscal crisis are limited. The public debt officially is 250% of GDP, but net of the assets of foreign assets of the BOJ is more like 150. The BOJ has already bought maybe 30% of the outstanding JGBs. If it were to buy half of them over time, then the net of the one that monetized will be significantly less than 100% of GDP. So that's what that monetization is. So the fiscal measures are different whether you're considering gross or net debt and the part that is monetized on a permanent basis. It's clear that the key elements of Abenomics made sense. You want initially to have a fiscal stimulus and eventually medium-term fiscal consolidation. You want to have monetary easing to boost aggregate demand and fill the upper gap, and you want to work on the supply side of Abenomics. Of those three pillars, the one that's been most disappointing has been the third pillar. The progress towards structural reform has been significantly less than optimally desirable. The monetary is doing its own share increasingly. But on the fiscal side, I think that Japan front-loaded some of that fiscal consolidation too early before growth had really started to jump-start it. And in order to stabilize deficit and debt, you need to have economic growth, because without economic growth, debt and deficit are going to become out of control. So I would not say that Abenomics has failed, but I would say that a renewed effort to do the stuff that works on the supply side is necessary. I would say that for the time being, giving up the fiscal consolidation in the sense of postponing it will be the right policy, because the economy is going to another downturn. And for the time being, there is no other option but for the central bank doing a variety of unconventional monetary policy that support aggregate demand until the economy and inflation has recovered sufficiently. So I would not say that in the short run, with what the BOJ does, there is a risk that there's going to be a fiscal or a currency or a debt crisis in Japan. 5 years from now, if there is not enough structural reform, if eventually the fiscal problems are not resolved, you're going to run out of monetary policy bullets, but you still have a window of 5 years where the right thing can be done, and therefore there will be light at the end of the tunnel of Japan. So I would not give up on Japan, even if, of course, there is a meaningful amount of economic and financial difficulties in the short term.
Hi, I'm Mary Kay Magstad. I'm with Public Radio International's program, The World, long based in Beijing, now in the US. And I have two questions, one looking backward, one looking forward. To what extent do you think China's current economic challenges have any parallels with what Japan went through in the early 90s? And what might China, or what should China learn from Japan's experience on that front? Looking forward, you didn't mention India. And I'm wondering how much you think India's growth rate, which is considerably higher than China's now and one of the highest in the world, might be a bright spot in the global economic future in the medium to long term.
Well, on the first part of your question, I would say, there are certainly some similarities. I wouldn't say it's exactly the same one. Of course, Japan is more of a market economy than China is. The role of the state-owned enterprises and fixed investment being excessive, 50% of GDP, and having too much, credit fuel fixed investment, increasing bad assets, bad debts, and bad investment is a much bigger problem in China than it was in Japan. But there are similarities along the following lines. For a while after the bursting of its own equity and real estate bubble, Japan, first of all, did not have the right policy framework on the macro side. They got to zero policy rates and QE too late, and the fiscal stimulus was delayed for a while. So there was a depression of aggregate demand that lasted for too long. And secondly, of course, you had a whole bunch of zombie banks and zombie corporates. And the first response was evergreening, as opposed to doing a operational financial restructuring of the corporate system and banking system. And that kind of evergreening over time led to a situation in which credit growth became very anemic, economy stagnated, went into a stagnation, and then deflation kind of sets in. That is important for China because China, the policymakers are realizing that they have to rebalance the economy from fixed investment to consumption, from net exports to domestic demand, from capital-intensive and resource-oriented growth to labor-intensive growth, and for service consumption, and so on and so on. But their tendency is to postpone the rebalancing, postpone the structural reform, postpone the cleanup of the state-owned enterprises, and so on, because there is this paramount objective of maintaining growth at 6.5% to 7% in the short term, where potential growth right now is below 6, going towards 5 very soon. And the only way you can try to prevent growth from falling below 7 is to do new rounds of credit fuel investment that implies more bad investment, more bad assets, more bad liabilities that are going to be eventually a burden for the banking system and for the sovereign and for the fiscal balances of the country. So if you're going to kick the can down the road, postponing the rebalancing, the structural adjustment need to occur, as I said, I'm not in a hard landing camp for China because they have policy tools, but you're going to create a bigger debt and leverage problem, and the financial and economic and fiscal loss are going to be bigger down the line, and the slowdown of growth down the line is going to be bigger, and the risk of a harder landing rather than a bumpier landing tend to increase. So the lesson is that aggressive, front-loaded policy action, both on the structural side and on trying to maintain macroeconomic performance in the short run, are key to avoid a situation that over time leads you either to a stagnation, if not to an outright financial crisis. You know, on India, I was there recently. I would say there are good news and there are bad news. The good news about India, I could say, is that India is the fastest growing large economy in the world, with official growth rate well above 7%. Even if whenever you go to India and you talk to people in the private sector, they don't believe those numbers. There's a bit of an economic malaise. Exports are sluggish. The world economy has negatively affected them. The business sentiment has improved, but not radically. The constraints and the red tape to doing investment and so on are still there. Yes, compared to the 5% growth of the previous government, 7% is an increase, but most people believe that the numbers, they're not fudged, but they are probably mismeasured, and the actual numbers are less. Credit growth has slowed down, real rates are high, there are issues of corporate governance, radical privatization or reforms of state-owned enterprises, state-owned banks has not occurred. There's still restrictions there are political constraints to doing some of the structural reform, whether it's land reform, labor market, the GST has not passed, and so on. So on one side, you could say the Modi government is an improvement compared to the other one. The growth rate of India is much better than most economy in the world. But I think that Modi has been a disappointment because rather than being a regime change in direction of real market-oriented reform, has been more continuity with more gradualism in those economic reform. And if those reforms are not legislated and implemented, eventually the growth momentum might actually fizzle out. So it's a positive compared to a world where, say, among the BRICS, take the BRICS, 2 of them are in recession, Brazil and Russia. One, like South Africa, is barely growing, and China is sharply slowing down. So 7% growth, even if it's not truly 7, is quite an accomplishment. But for a country as poor as India, with so much inequality, with so much poverty, you have to do better than that over time. Otherwise, eventually, political and social, there'll be disappointment.
Okay, do we have time for maybe one more?
Yeah,
It's 20 past 12 now. Are we okay for
Yeah, I'll be happy to take it.
12:30, maybe 2
Yeah.
questions?
Yeah, 2 questions. Maybe.
Okay, go for Daniel, and you two can fight it out.
Hello, I'm Daniel Eskenazi, freelance journalist from Switzerland. In a developed country like Japan, I mean, what kind of measure should you implement to achieve a growth, considering the fact that you don't have immigration and you have a declining demography?
Well, I know that from a political point of view, it's still a matter that has a significant challenge because traditionally, culturally, Japan is not open to have as much migration as other countries in the world. But, it's an aging population, first of all. Japan is already working, of course, on trying to increase the labor force participation rate of women, and some improvements occurred. But, one of the many, among other reasons why maybe women, once they have a family, have children, give up on working is that either there is not affordable childcare or there is not availability of help, household help. And given the constraints of the supply of labor, there are plenty of, say, Filipinos that are well educated who could become those type of family help, or in aging society where the need for nursing services for the elderly or the sick is larger. Again, you can find qualified workers from abroad who could satisfy those needs. Or now that there's going to be the new Olympic Games coming up, there'll be a significant demand for construction workers, and there's no reason why you should not be allowing construction workers to come into Japan and providing the needed jobs that are needed. So I'm not an expert of Japan. I don't know how much the cultural mores over allowing more foreign workers on a semi-permanent basis come and stay in the country could change. But unless you can very sharply increase the labor force participation rates of parts of society that have it low, and even in the case of the women's labor force participation rate, unless they have enough foreign workers and help them in household chores and childcare, that increase is not going to occur. You're going to have a problem with declining potential growth and innovation and so on that comes from an aging society. So I think that of all the things that Japan can do, that's something on which a national discussion on this thing should occur and maybe is likely to occur. There's plenty of other stuff that, of course, Japan can do in increasing competition in the service sector, in liberalizing agriculture, into becoming a greater innovation and startup society, and so on and so on. It's a long list, shopping list of stuff that needs to be done. And I would say that after a beginning of Abenomics where there was some stress on those third arrow reforms, there's been a loss of fizzle, and there is not much on the legislative agenda that goes in that direction. But that agenda has to be put back on the table in all its different dimensions. Otherwise, potential growth is going to remain stagnant over time.
Okay, thank you. We'll take questions from both of you, but keep it short. And Dr. Roubini, if you could keep your answer short as well, please.
Yeah.
Yep.
Makoto Honjo, associate. You said that the oil price drop was unexpectedly turned out to be a negative impact on the world economy, despite expectations that it would make a growth in the long run. And I was wondering whether what kind of time horizons you will have on the assumption that of rising economy, on the assumption that oil prices will stay relatively low.
Well, I distinguish between the economic impact of lower oil prices and the financial market impact. I said from an economic point of view, a fall in oil prices, as long as that fall in oil prices is driven by positive supply shock, should be on net over time positive, because you're essentially redistributing income from oil exporting countries that tend to have a high marginal propensity to save that oil windfall rather than spend it, to countries that are net oil importing countries that have a higher marginal propensity to spend it. So that redistribution of income on net should be increasing global aggregate demand and lift global economic growth. And I pointed out that some of the major regions of the world are net oil importing countries, and therefore that positive impact should occur over time. Now, even in the United States, where people say, well, we have a lot of domestic production of oil, that's true, but U.S. is still importing half of its consumption, so it's a net oil importing country. So even in the United States, while the producer of oil and energy lose, the positive impact on the consumer of oil and energy is greater than the loss for the producer, and therefore the net impact for U.S. economic growth should be positive over time. But of course, whenever oil prices fall, in the short run, the producer react faster by cutting production, employment, and capital spending. The consumer take their time to see whether that fall in oil price is permanent or transitory. So in the short run, output looks like weaker, but in a matter of 2 or 3 quarters, output tends to be rising as is being spent, and has been spent even in the United States. Now, in some parts of the world, the impact on demand has been dampened because, for example, in Europe, there is high taxation of gasoline, and therefore that high taxation of gasoline implies that the positive impact on household income is less. Or in parts of the world like China or India or Indonesia, the government took the oil price fall as a way of reducing the subsidies to the private sector, and therefore the benefit has gone to the fiscal balances of the government as opposed to spilling over to the disposable income and the consumption of the housing sector. So there are a number of reasons why the impact economically of a fall in oil prices is dampened or gradual over time, but on net, as long as there's a positive supply shock, global growth gradually, not by massive amounts, should be slightly higher rather than slightly lower. Now then there are the financial market impact, first of all, that I discussed. If it leads to significant systemic credit spread distress, then you could have a contraction of investment that implies that the net positives are smaller than otherwise. If you have global equity sharply falling, that's a negative impact, and so on and so on. So those are the elements of financial kind of transmission that have to be considered when you consider the overall impact of this fall in oil prices.
Okay, thank you. For the final question now from Finbar.
Okay, great. So we've seen with negative interest...
Your name and affiliation, please.
Okay, Finbar Flynn from Bloomberg. So we've seen with negative interest rates a flow of yen funds into the US, into corporate debt, into treasuries, into high yield debt. And you're also seeing that from last year, I think also from European countries flowing into the US. From a Japanese perspective, maybe also from a European perspective, do you think is that good for the United States and good for investors in US assets? And how is it for actual investors here in Japanese yen and in the Euro region? Thank you.
Well, you know, whenever there is monetary accommodation, whether it's through the price of money or the quantity of money, the transmission effects are in part portfolio, credit, wealth effects. Part of them are also through the currency. And of course, the G20 said we should not use monetary policy to actively weaken the currency, but it's totally kosher that if you need to ease monetary policy because growth is weak and inflation is too low, that if then as a side consequence of your monetary easing, your currency weakens and that boosts your net exports, that's acceptable rules of the game. What's not acceptable is actively intervening in the FX market or actively talking down your currency. Those are the G20 rules of the game. And the impact, therefore, on the United States is a mixed bag because the weakening, if it were to occur, of other currencies that have monetary easing would imply a strengthening of the US dollar. The strength of the US dollar is a negative for inflation and for growth in the United States by making the trade deficit of the US larger. The inflow of money that comes from the rest of the world into the United States keep long rates in the United States lower than otherwise. It can increase the price of risky assets like US equities or credit, and therefore the net impact on financial condition is still a mixed bag, tightening to the currency, easing through the impact on asset prices. I would say that over time, of course, the concern in the US will be that if the rest of the world aggressively tries to weaken its currency, and therefore the only currency that appreciates is the US dollar because EM currencies are weakening, commodity currencies are weakening, the euro is weakening, the yen is weakening, then eventually excessive appreciation of the dollar would imply problems in terms of US achieving its growth target, in terms of achieving the inflation target, that would undermine economic growth in the United States and then force the Fed to stop hiking or even reverse itself. So those types of impacts have to be considered when you're considering what are the implications of having changes in monetary policy in the rest of the world.
Okay, thank you very much indeed. Okay, that wraps up this very, very interesting press conference. Thank you very much, Dr. Roubini. Most appreciated. Can we give him a round of applause, please?
Thanks.
And before I let you go, there's two things. First of all, here's a complimentary membership to the club for 1 year. So please come and have a drink with us anytime you like.
Pleasure.
And secondly, could you just sign our guest book, please?
Yeah, of course.